China has just done something that is set to change the global economic landscape for a very long time. And if you are not paying attention to what is happening right now, one day you may wake up asking yourself how we arrived at a completely different world without anyone clearly explaining it to you. We are talking about a decision that the United States had been watching with concern for decades, a move that strategists in Washington had anticipated for years, and China finally carried it out. It sold U.S. Treasury bonds in very large amounts. Now, I know that for many of you this may sound like boring financial language, like something that only matters to bankers on Wall Street or officials at the Treasury Department. But let me be absolutely clear with you. What just happened is far more important than any recent election, any political speech, or any newspaper headline you have seen in recent months. This is a major shift in the foundations of global economic power, and its effects are going to influence your life, your job, your savings, and your future, whether you choose to follow it or not. Let me explain exactly what this means and why you should pay close attention. For more than 50 years, since Richard Nixon ended the gold standard in 1971, the United States has operated under a system that I and many other critical economists have called the exorbitant privilege of the dollar. This is not a balanced system, and it is not a system based purely on merit. It is a system built on a very large structural advantage that allows the United States to live far beyond its means, while much of the rest of the world carries a significant part of the cost. This is how it works. The United States prints dollars. Those dollars are accepted globally as the world's reserve currency, which means all countries need dollars to trade with each other, to buy oil, to build reserves, and to protect themselves during crises. And because the world needs dollars, the United States can issue this currency without facing immediate and obvious consequences. It is like having a money printer in your basement while all your neighbors agree to accept that money as valid payment. No matter how much you print, no matter how careless you are with your personal finances, you can always create more money, and someone will accept it because everyone depends on that system. Now imagine that one day your biggest neighbor, the one with the most successful business in the area, the one who has been accepting your printed money for decades, suddenly says, "You know what? I do not want your money anymore. I am going to use something else. I will use gold. I will use my own currency. I will trade directly with other neighbors without going through you." That is essentially what China has just done, and the implications are truly enormous. But to really understand why this matters so much, we need to go deeper into how this system works and why it is not sustainable over time. I have spent decades studying capitalism, its crises, and its internal contradictions, and I can tell you that the current system of the dollar as the world's reserve currency is one of the largest economic distortions in modern history. It allows the United States, a country that represents less than 5% of the world's population, to consume close to 25% of the planet's resources. How is this possible? Because the United States can finance massive trade deficits year after year, decade after decade, simply by issuing more dollars or selling more dollar-denominated debt that other countries buy. Think about it this way. If you and I spent more than we earned every month, eventually our credit cards would be maxed out, banks would stop lending to us, and we would face serious financial trouble. But the United States has been spending more than it produces for more than 40 consecutive years, building up enormous trade deficits, and instead of facing immediate consequences, the rest of the world has continued to finance that lifestyle by buying U.S. Treasury bonds. China has historically been the largest foreign buyer of these bonds, At its peak, China held more than $1.3 trillion in U.S. Treasury securities. That is $1.3 trillion. To put that into perspective, that is more than the entire GDP of countries like Mexico or Indonesia. In practice, China was lending the United States extremely large amounts of money, and the United States was using that borrowed money to fund its extensive defense system, to finance military operations in places like Iraq and Afghanistan, to support tax cuts for wealthier groups, and to provide support to large corporations. So the obvious question is, why would China do this? Why would it finance its main geopolitical competitor? And this is where many traditional analyses fall short. They will tell you it was a mutually beneficial relationship that both sides gained. The United States received cheap financing for its deficits. China gained access to a huge market for its exports. Chinese workers produced goods that American consumers bought with borrowed money, and that money flowed back to China in the form of dollars that the Chinese government invested in Treasury bonds. A seemingly positive cycle, they say. But that explanation hides a crucial power dynamic. China did not have many real alternatives. When a country runs very large trade surpluses with the United States, it accumulates dollars, and those dollars have to be placed somewhere. You cannot simply let them sit idle. You need to invest them. And for decades, the largest, most liquid, and seemingly safest option was U.S. Treasury bonds. It was the only market deep enough to absorb the massive flows of dollars China was generating. However, there was a serious weakness in this system that China came to understand more clearly over time. By holding so much of its reserves in U.S. Treasury bonds, China was making itself highly exposed to U.S. financial power. If Washington decided to freeze those assets, China could lose access to more than $1 trillion of its national wealth. If Washington decided to issue very large amounts of new dollars through expansive monetary policies, the real value of China's holdings would decline. If Washington chose to use the financial system as a tool of geopolitical pressure, something it has done repeatedly with countries like Iran, Venezuela, Russia, and Afghanistan, China would be vulnerable. And here is the key point I want you to understand. China watched very carefully what the United States did to Russia after the conflict in Ukraine in 2022. Washington froze approximately $300 billion of Russian central bank reserves. Russian. Read that again. The United States and its allies effectively took control of $300 billion in the foreign reserves of another country. No matter what you think about Russia or the war in Ukraine, this was a defining moment in global financial history. It showed, without any doubt, that dollar-based assets, even central bank reserves that are supposed to be protected within the international financial system, can be frozen, held back, and used as a tool of pressure if a country challenges the interests of the United States. Now put yourself in the position of strategists in Beijing. You hold $800 billion until recently more than $1 trillion in U.S. Treasury bonds. You know the United States sees you as its main strategic competitor. The Pentagon has clearly identified China as its primary challenge. The United States is building military alliances in Asia specifically to limit China's influence. It is placing tariffs on Chinese goods, restricting technology exports to China, and constantly talking about defending Taiwan with military support. And at the same time, you have $1 trillion of your national wealth in assets that this same country can freeze with an executive order. What would you do? The answer is obvious. You would reduce exposure, diversify, and look for alternatives. And that is exactly what China has been doing, not in a rushed way, not in a chaotic way, but in a methodical, strategic, and calculated manner. Data from the U.S. Treasury Department shows this trend very clearly. China has been selling U.S. Treasury bonds consistently for years. From more than $1.3 trillion at its peak, it now holds less than $800 billion. That is a reduction of over $500 billion. $500 billion that is no longer financing the U.S. deficit. $500 billion that China has shifted into other assets, other investments, and other forms of value storage. And China is not alone. Japan, historically the second largest holder of U.S. treasuries, is also reducing its positions. Saudi Arabia, the country that signed the petrodollar agreement with the United States in the 1970s, is diversifying its reserves and is considering selling oil in yuan. Central banks around the world are buying gold at rates not seen in decades. Russia has reduced almost all of its holdings of U.S. Treasury bonds. India is accumulating gold. Brazil is making trade agreements in local currencies. The entire system that kept the dollar at the center of global trade is slowly weakening, and most people do not even notice because mainstream media is too busy talking about what some politician posted online or the latest celebrity scandal. Now let me anticipate the argument from defenders of the current system. They will say, "Richard, this doesn't matter. The United States will always find buyers for its bonds. The dollar is too big to lose its position. There is no real alternative. China would hurt itself if it sold all its bonds because it would damage the value of its own holdings." On the surface, these arguments can sound convincing, but they fall apart with even modest scrutiny. First, the claim that there is no alternative to the dollar. That was true 20 years ago. It is no longer true today. China has systematically built alternatives to the dollar-dominated system. It created CIPS, China's cross-border interbank payment system, which is essentially its own version of SWIFT. SWIFT is the system that moves money internationally, and the United States has strong influence over it and has used it as a tool to apply sanctions on other countries. With CIPS, China can move money internationally without relying on systems that Washington can directly monitor or control. China has also been actively promoting the use of the yuan in international trade. It has currency swap agreements with dozens of countries. It is setting up yuan clearing centers in major cities around the world. It is pricing more and more of its foreign trade in yuan instead of dollars. And perhaps most importantly, it is backing all of this with gold. China has been one of the largest buyers of gold in the world for years. It does not publish exact figures, and that is intentional from a strategic standpoint, but all estimates suggest it has accumulated thousands of tons of gold. Why gold? Because gold has a property that U.S. Treasury bonds do not. It cannot be frozen, it cannot be sanctioned, and it cannot be created at will. It is real, tangible wealth that exists independently of any government's decisions. If tomorrow the United States froze all Chinese dollar assets, that gold would still hold its value. It is the ultimate form of protection against U.S. financial power. Second, the argument that China would damage itself by selling its bonds confuses short-term tactics with long-term strategy. Yes, if China dumped all its bonds at once, prices would fall and the value of its own holdings would drop. It would be like trying to sell 100,000 shares of a company at the same time. You would flood the market and the price would collapse. But that is not what China is doing. It is selling gradually and consistently over many years. It is reducing exposure without creating panic in the market. It is the difference between running out of a burning building in chaos and evacuating in an orderly way. You reach the same outcome getting out but with far less damage. And here is the deeper truth that many defenders of the dollar prefer not to acknowledge. China can afford to accept some losses on its Treasury holdings if that means avoiding a much larger strategic trap. Think about it this way. If you have $1 million invested in something you believe will eventually lose value, would you rather sell now for $800,000 or wait and risk losing far more later? China is making the strategic calculation that it is better to accept controlled losses now than to remain fully exposed in the future. But the biggest problem for the United States is not just that China is selling bonds. The real problem is that the United States needs buyers more than ever. Look at U.S. budget deficits in recent years. They are massive, trillions of dollars every year. Interest payments on the existing national debt alone now exceed $600 billion annually, and that number keeps rising as interest rates increase. The United States is caught in a debt cycle. It has to borrow more each year just to pay interest on what it already owes, on top of funding regular government spending. And if traditional foreign buyers, China, Japan, and oil-producing countries, are reducing their purchases, then someone else has to fill that gap. So who buys the bonds when foreigners stop buying? The Federal Reserve, the U.S. Central Bank. And when a central bank buys government debt, there is a technical term for that, debt monetization. In simple terms, it means the government is creating money to finance itself. And this is exactly what we saw. During the pandemic, this happened on a scale never seen before. The Federal Reserve literally bought trillions of dollars in Treasury bonds. It expanded its balance sheet from less than $4 trillion before the pandemic to more than $9 trillion at its peak. That is over $5 trillion created out of thin air and used to buy government debt. And what was the result? The highest inflation in 40 years. Food prices rose by 20, 30, even 40%. Gas prices surged. Rent costs shot up. Real wages fell because pay increases could not keep up with rising prices. Working people were hit hard, while asset owners, people with stocks and real estate, became richer because all that money creation pushed asset prices higher. This is what I call the class effect of monetary policy. When the Fed creates money, it does not affect everyone equally. It strongly benefits people who own financial assets. It hurts people who live on wages and whose savings lose buying power. So when people ask me, why does this matter? Why should you care that China is selling Treasury bonds? Here is the answer. It creates an impossible math problem for the United States. Either the U.S. government cuts spending dramatically, which is politically unrealistic, or the Fed keeps creating money to buy debt that no one else wants. That means more inflation, which means your money buys less, which means your standard of living falls. There is no easy way out of this contradiction. It is the unavoidable result of decades of living beyond our means, of funding overseas conflicts with debt, of cutting taxes for the wealthy while expanding military spending, of rescuing banks and large corporations while letting infrastructure decline. This is the long-term consequence of those choices coming back into view. And let me be clear about something else. This is not just numbers on a spreadsheet. This is about power. The dollar-based system has been the foundation of U.S. global influence for more than half a century. It has allowed the United States to maintain hundreds of overseas military facilities. It has allowed the U.S. to impose financial restrictions on countries it disagrees with by cutting them off from the global financial system. It has allowed the U.S. to support a defense budget larger than the next 10 countries combined. All of this depends on the special position of the dollar. And if that position weakens, the entire structure of U.S. influence starts to shake. Now let me address another argument I hear all the time. People say China has its own problems. Its property market is under stress. Its population is aging. Its economic growth is slowing. They say China cannot really challenge the United States. All of that is true. China absolutely has serious structural issues, but this is not about China being perfect or China replacing the United States. This is about the world no longer wanting to put all its eggs in the dollar basket. It is about diversification. It is about having choices. For the first time in 50 years, countries have real options about where to hold their reserves, which currency to use for trade, and how to protect themselves from financial instability. And they are using those options. Look at the growth of BRICS. Brazil, Russia, India, China, South Africa. These countries now represent a larger share of the global economy than the G7. They are actively discussing creating a shared trade currency among themselves. They are setting up development banks that compete with Western-dominated institutions like the World Bank and the IMF. Saudi Arabia, the most important US partner in the Middle East for decades, is talking about joining BRICS. They are considering selling oil in yuan. 10 years ago, this would have been unthinkable. The petrodollar system, where oil is sold only in dollars, has been a major pillar of dollar strength. If major oil producers begin accepting other currencies, that pillar weakens. And it is not just BRICS. Countries around the world are signing bilateral swap agreements to trade in local currencies. Argentina and Brazil trade in their own currencies. India and Russia trade in rupees and rubles. China and Saudi Arabia are discussing trade in yuan. Each of these deals is small on its own, but together they represent a major trend, the gradual move away from dollar-based trade, and central banks are showing their preferences through their actions. Data from the International Monetary Fund shows the dollar's share of global reserves has fallen from over 70% 2 decades ago to around 58% today. That is a significant drop, and gold, as mentioned earlier, is being accumulated at record levels. Central banks bought more than 1,000 tons of gold last year alone. They are moving wealth away from US-backed paper assets into real assets that cannot be easily frozen or restricted. So the question facing the United States is fundamental. How do you maintain the dollar's special position when the world no longer wants to grant it so freely? And this is where the options become very limited and very risky. Option one is that the United States accepts a multipolar world where the dollar remains important but no longer dominant. This would require humility. It would require reforming international financial institutions to give developing countries more influence. It would require accepting limits on US power. Based on history and current politics, this seems very unlikely. The US leadership is not prepared to give up this advantage voluntarily. Option two is that the United States tries to force the world to keep using the dollar through pressure. More sanctions, more pressure on partners, possibly even direct actions to control strategic resources or trade routes. This is dangerous because it turns an economic transition into geopolitical confrontation. And honestly, based on recent history in places like Iraq, Afghanistan, and Libya, this is an option US leaders would seriously consider. Option three is that the United States stays on its current path, creating more money to fund deficits, piling up more debt, and eventually facing a fiscal crisis where bond markets seize up, interest rates spike, and the economy falls into a deep downturn. This is the hard landing scenario, and every year that passes without serious reform makes it more likely. Option 4, and I think this is the most likely, is gradual fragmentation. The global system breaks into currency blocks. A dollar bloc led by the United States and its closest partners. A yuan bloc centered on China and its trading partners. Possibly other regional blocs as well. The world becomes more unstable, more unpredictable, more prone to tension, but there is no single dramatic collapse, just a steady erosion of the old order. And this brings us back to China selling US bonds. What China did was not an isolated move. It was a signal. It was a demonstration that they have alternatives, that they are no longer locked into the dollar system, that they can protect their national wealth from what they see as risky financial decisions in Washington. And that signal is being clearly received in capitals around the world. Other countries are watching this. They see that China can do this. They see that there is life beyond the dollar. They see that the image of absolute US financial dominance may not be as solid as it once seemed. And once that perception takes hold, the process feeds on itself. More countries sell bonds, which pushes interest rates higher. That makes it more expensive for the United States to finance its debt, which leads to more money creation, which fuels more inflation, which further weakens confidence in the dollar, which leads to more bond selling. It is a negative feedback loop, the exact opposite of the positive cycle that kept the dollar on top for decades. So what does all of this mean for you, the average person watching this? It means the world you grew up with, the world where the United States set the rules, where the dollar was king, where we could consume more than we produced without clear consequences. That world is fading, and that will have real effects on your life. If the dollar weakens, imports become more expensive. That means higher prices for almost everything, from electronics to clothing to food. If the United States has to pay higher interest on its debt, there is less money for everything else. Education, infrastructure, public services. If we enter a fiscal crisis, we could see deep cuts to programs that millions of people rely on. If the global economy fragments, you may see supply chain disruptions, product shortages, and job losses in industries tied to international trade. None of this is abstract. None of this is just economic theory. This affects your ability to pay rent, to buy groceries, to plan for your future. And what frustrates me most is that none of this was unpredictable. Critical economists like me have been warning about these contradictions for decades. We have been pointing out that you cannot fund an empire with debt forever.